one of the more pleasant surprises for people as they approach retirement is just how much control they have over the taxes that they pay. And that may sound counterintuitive, but bear with me. Let's say you've got money in a Roth IRA, money in a regular IRA or 401k, and money in a regular savings account. And let's say you have the same amount of money in all three of those buckets, $100,000 in each. Guess what? Depending on when and how you take your money out, your taxes, your overall taxes during your retired life is going to change, and it can change dramatically. It can be tens of thousands of dollars, if not more. So the order in which you take money out and how you take money out of those buckets of retirement accounts is really, really important. When you were working, most of us, if we were working for another company, we got a W-2 form, we got a couple tax forms from our bank, maybe a brokerage account, and our taxes were what our taxes were. But in retirement, that's not the case. And it's a little complicated, but can also be worth tens of thousands of dollars, if not more, for you. So let's jump in. Let's go for a walk, and I'll chat more about this. So I mentioned those three buckets of money, the Roth IRA or 401k, the regular IRA or regular 401k, and then a taxable account. And the taxable account, like an online brokerage, your bank account, and your regular IRA and your regular 401k, those, as you take money out, let's start with your regular 401k and regular IRA. As you take money out, all of that money is going to be considered taxable income. And there's 7 tax brackets in the United States. You can see in this graph what they are, right? 10%, 12%, and then a big jump, right? 22%. Then it goes up to 24, and then another big jump, 32%, 35, and 37. And it's those big jumps that present gotchas and also present opportunities. I want them to be opportunities for you. So you can see what the income brackets are for 2024 on taxes. And for most of us, we're going to benefit from trying to fill up those lower tax brackets. So that's how your regular 401k and your regular IRA is going to work. Every dollar you take out is going to be taxable income. Now, with your taxable bank account, where you have your savings account, you're getting interest, and maybe a regular brokerage account where you're getting dividends off of your investments, maybe some long-term capital gains, that money is taxed as it's realized, right? If you have invested in the stock that you paid $100 for, and it's now worth $200, but you haven't sold it yet, you don't have to pay tax on that. But when you do sell it, then if you've held it over a year, you're going to pay long-term capital gains. So just taking money out of your bank is not a taxable event. But what triggers the taxes, whether you take the money out or not, is when you sell a position or if you receive dividends or interest off of that account. So I mentioned the tax brackets. There's another table that I want you to look at. That is the standard deduction table. And basically what you do is you take your taxable income. Not an accountant, I need to say that. None of this is tax advice. This is really stuff I want you to put on your radar screen, but we all get to deduct from our taxable income the standard deduction if we want, or we can itemize. Most Americans end up taking the standard deduction. So you can see the standard deduction here, which if you're single in 2024 is $14,600, and it's $29,200 if you're married filing jointly. Importantly, though, if you're over 60, there's an additional standard deduction, which is $1,950 and $1,550. So above that age, you get an additional one. So for a single, it's $16,500 is the total, and $32,300. So you get your taxable income, and you can have $32,300 if you're married of taxable income, but still pay zero tax, right? But you still haven't used up that 10% tax bracket. So looking at these 3 buckets is really important. I call it filling up the tax brackets, and you want to make sure that you do that, because remember, it's over your lifetime. You want to optimize over your lifetime, and for some of us, after death because of estate tax, we want to look at that picture. And yes, it's complicated, but the dollars are worth it. It's worth understanding this. And for many of us, it's worth hiring a tax professional to help us with this. I want you to know that this is potentially out there. It's a huge benefit for you, but it can also be a trap if you don't know. And I don't want you to just blindly be taking money out. Now, one of the things I see, I've been a financial advisor now for over 20 years. And one of the things I see is retirees, their first couple of years are like, woohoo, we can pay zero tax. Let's do that for the first time in our life. We're paying the federal government nothing. I want to caution you on that, because while it feels good in the moment, what you're doing is you're leaving your money in these other accounts. And remember that on the tax brackets where I showed you that the taxes jump dramatically, right? 10 and 12%, not so bad, but then it jumps to 22%. There is no 14% tax bracket. There is no 16, 18, and 20. It goes right from 12% to 22%. And I want you thinking about how do you optimize this over your lifetime, not just your first year of retirement, your second year of retirement. So what are some things that you can do? One of the things you can do is you can move money from one bucket to the other. To move money from a regular IRA to a Roth, it sure would be nice if we could just do that. And the government says, hey, good idea. And you don't owe us any tax on that. But unfortunately, that's not how it works. It's called a Roth conversion. And when you convert from a regular IRA into a Roth IRA, the government considers the amount that you convert to be taxable income. So again, it all gets complicated. A good accountant can help you with this. You can optimize on it. And the question is, where's the money going to come from to pay those taxes, right? So as long as you have enough money in a taxable account to pay for some of that conversion, the numbers look different. So you're going to look at all three buckets for doing this. Now, the Roth IRA is kind of the superpower. Roth IRA, the Roth 401k is kind of the superpower account. Again, you never pay taxes on that money. It's once you put money in, I call it the tax me never account. And that's a glorious thing. So that's money that you want to kind of save up and use for last. We're going to talk more about this later, but one of the issues with a regular 401k and a regular IRA is there's something called forced income. In my industry, we call that required minimum distributions, which the government says, hey, at some point, you never did pay tax on this money when you put the money in. At some point, you have to pay tax on it. So if you're not paying required minimum distributions now, RMDs, then you're likely going to have to start taking them when you're 73. And you really want to make sure you take them, because if you don't, there's a 25% penalty on the amount that you should have taken that you didn't take. So the government's real serious about it, and you need to be serious about it. That's what makes balancing these accounts so important, is because at some point, you're going to have that forced income. And, before you have RMDs, you have a lot of control over what your taxable income is. But once the required minimum distributions start to kick in, then you lose a fair amount of that control. So the time to do these things is early. Start shuffling buckets. In fact, if you're watching this in your 30s and 40s, I want you to be thinking about how you're putting money into these buckets, such that when you're in your 60s, when you're ready to retire, 55, whatever it is, you've already balanced the buckets. So it's easiest to balance the buckets as you're filling them, but it's not too late if you haven't done that. You still can do those Roth conversions, but it is important to have all three of those buckets. Now, I talked about planning early, and one of the things is, most of us are planning on having Medicare when we turn 65. But there is another gotcha. It's called IRMAA, IRMAA, and that stands for Income Related Monthly Adjustment Amount. And essentially, that's a penalty that Medicare charges you if you have too much taxable income. If your income is too high, it's a penalty. It's a surcharge that they put on your Medicare payments. And you can see in the table here what that surcharge is in 2024. But here's the kicker. It's a 2-year look back. So IRMAA is looking at what was your income 2 years ago. So if you're 63 years old and you're going to take Medicare at 65, now is the time to be looking at IRMAA and be balancing things out. And what's hard is the table I just showed on screen, that is the 2024 IRMAA. But what you need to know if you're 63 is what's the 2026 IRMAA going to look like? And guess what? The government doesn't show us that, doesn't give that to us. So we're penalized. We have to pay an additional premium, if you will, an adjustment if we made too much money, but the government doesn't tell us what those cutoffs are. So there's a lot of judgment involved in all of this. Okay, so this video is which buckets should you take your money out of first, right? What is the withdrawal order? And as I've pointed out, and hopefully you've picked up on this video, it's kind of complicated and it's best done with an accountant, but I don't want to leave you hanging. Again, the goal of my channel is to put things on your radar screen to think about. This is not financial advice for any one person. I don't know your situation, so I can't give you financial advice. And I'm certainly not an accountant, and I'm certainly not giving tax advice. But what I can do is I can point you to an article by Charles Schwab, and it's called How to Plan Your Retirement Withdrawal Strategy. And I think Charles Schwab, I have a lot of respect for the research in the articles that Schwab, Fidelity, BlackRock, firms like that put out. And I try to stay on top of them. And when I find a report that I think is useful for my audience, I like to point it out. And this is a case where there's a very useful article. You can download it for free. Just Google that term, How to Plan Your Retirement Withdrawal Strategy. You can see an image of it here on the screen. But Schwab says in their report, first you take out your RMDs. Of course, you don't have a choice. If you don't do that, you're going to get hit with that 25% penalty. You don't want that to happen. Then Schwab would say the second thing is you're going to pay tax on your dividends and interest in your taxable accounts anyways, so withdraw those. The third place is as you have bonds and CDs maturing in a taxable account. That's another place you've already paid tax on that money, so you might as well pull that money out. That's number 3. Number 4 is, again, in your taxable accounts, look at your capital gains on any investments that you might have, particularly long-term capital gains because they're taxed favorably in the United States. So positions, investments that you've held over a year. And then also look at your losses, any position that's at a loss, or if it's just at break even. Right? Because you can, let's say you invested $10,000 in a stock and you paid $12.10 for it, and it's now $12.11. Well, if you take out that $10,000.20, whatever it is, you've only got a very, very small amount of capital gains on that because you only gained a penny, I think, in the example that I used. Schwab would then say, look at your long-term capital gains in your taxable accounts and your losses. And then the final place Schwab would say to take money out is from your Roth. And the reason you want to leave your money last in the Roth is that's the account that gives you the most flexibility. That's the account that in many ways has the most quote-unquote power. So those are the main areas to be thinking about. I also want you to be thinking about enjoying your journey up to retirement. And these are 7 things that I encourage people in their 50s and above to stop doing along the way to enjoy the journey more. It's not just about getting to retire, but it's about enjoying the journey. So I'll see you in that video. Thanks for watching this one.